Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within corporate filings, and today we're diving into Meritage Homes' latest report. Get ready, because it looks like this quarter was a bit of a reality check with a big drop in profits that we need to unpack. Before we start this deep dive, if you love getting straightforward insights from these financial reports, make sure you hit subscribe. And hey, we've got a fantastic community over on Discord, so join us there too. The link is in the description below. Trust me, you won't want to miss out. Alright, let's get straight into it. Meritage Homes Corporation, a big player in building homes, has just dropped its quarterly report, and let's just say the numbers are telling a story. When we look at the income statements, the first thing that jumps out is the home closing revenue. For the 3 months ending the 30th of September 2025, it was $1.4 billion. That sounds like a lot, right? But compare that to the same period last year, 2024, when it was $1.6 billion. That is a drop of about 11.8%. We're talking about losing more than $1 in $10 of revenue here. This dip in revenue is a big deal. It is mostly because they closed fewer homes, down 6.5%, and the average price they got for each home also dropped by 5.6%. It's like trying to sell fewer cars, and also having to lower the price on the ones you do sell, and that lower revenue really hit their profits. Home closing gross profit for the third quarter of 2025 was $267.0 million. That sounds good. But last year it was a much healthier $392.6 million. That is a massive drop of about 32%. Imagine your profit shrinking by almost a third. Now, profit margin is super important. Their home closing gross margin, which is the profit they make on each home after subtracting the costs to build it, was 19.1% last year. It was 24.8%. That is a 5.7 percentage point drop. Think about it, for every $100 of home sales, they're making nearly $6 less profit than they were a year ago. That is a significant squeeze. The company says this is due to higher costs for incentives to get people to buy, meaning they're discounting homes more, and also because their lot costs went up. Plus, with fewer homes closing, they couldn't spread their fixed costs out over as many sales, making each sale less efficient. The problems aren't just company-wide, they're hitting different regions hard. Take the West region, for example. Home closing revenue there dropped by a huge 29.2% compared to last year. They closed 27.6% fewer homes, and the average price also went down a bit. The Central region also saw a decline, with revenue down 8.6%. They sold fewer homes, and again the average price was lower. It seems higher incentives are really eating into profits across the board. The East region actually showed some growth, with revenue up 5.7%. They closed 12.1% more homes. However, even with more homes sold, the average price per HOME was still lower, so while they sold more, they made less profit per HOME sale. Now, let's talk about new orders. For the 3 months ended the 30th of September 2025, they had 3,636 home orders. That is actually a bit higher, up 3.5% compared to last year. This is thanks to having more active communities, which is good, but the amount of money from these new orders was pretty flat, mainly because the average sales price for these new orders is also down. It's like getting more potential customers, but they're buying cheaper items. The home order value for the third quarter of 2025 was $1.4 billion, which is almost the same as last year. This means while they're getting more people to sign up, the total value of those deals isn't really growing. And what about their backlog, the value of homes already sold but not yet closed? That is down quite a bit. At the end of September 2025, their backlog was valued at $670 million, a 28.1% drop from last year. They only had 1,699 homes in that backlog, down 25.6%. This is partly because they're selling homes later in the construction process. As part of their strategy to have homes ready to close quickly, it sounds like they're selling them faster, which is good, but it also means fewer committed sales are stretching out into the future. An interesting point is they ended the third quarter with 334 active communities, which is up significantly from 278 last year. This expansion should ideally lead to more sales, but as we've seen, lower prices and higher costs are making it tough to translate that into profit growth. These costs, which include things like sales commissions and advertising, actually went up. They were 7.1% of home closing revenue compared to 6.2% last year. This increase is because they're paying higher commissions to realtors and spending more to maintain completed homes that aren't selling as fast. Essentially, it is costing them more to sell homes. On the flip side, general and administrative expenses, which are things like salaries and office costs, actually went down for the quarter. They reported $51.8 million, a decrease from $59.2 million last year. This is mainly due to lower compensation costs. That is a bit of good news for operational efficiency. Their financial services segment, which includes things like title and mortgage services, also saw an increase in profit. It was $4.5 million for the quarter, up from $3.1 million last year. This improvement was mainly because they had fewer charges related to interest rate deals expiring. So while the core home building business is struggling, their side businesses are doing a bit better. Now let's talk about money in the bank or liquidity. They ended September 2025 with $728.9 million in cash and cash equivalents. Plus, they had $825.9 million available under their credit facility. That is a pretty substantial amount, giving them around $1.6 billion in total available funds. This means they have enough cash to keep things running, pay for new homes, and acquire land. Looking at their debt to capital ratio was 25.7%. That means for every dollar of capital they use, about 26 cents comes from debt. Last year, it was 20.6%, so they're using a bit more debt than before. And their net debt to capital ratio, which is debt minus cash, was 17.2%. This also increased from 11.7% last year. This suggests they're carrying more debt relative to their cash reserves. They did issue $500 million in new senior notes in early 2025, which adds to this. The good news is that they are currently meeting all their loan requirements. Their tangible net worth is well above the required amount, and their leverage ratio is comfortably below the 60% limit. Historically, Meritage Homes sees more home orders in the first half of the year, which means they need more cash in those quarters to prepare inventory. However, with their new strategy of selling homes later in the building process and aiming for quick closings, they might be shifting when they need that cash. Now, let's put all this together. Meritage Homes is clearly navigating a tough housing market. Higher interest rates mean fewer people can afford homes, and more existing homes are coming onto the market, creating competition. Their strategy to offer move in ready homes and use incentives like interest rate buydowns is smart, especially when competing with resale homes that can't offer these perks. However, these incentives, along with rising land and building costs, are really hurting their profit margins. It is like they're having to discount their products more to sell them, while their own costs are going up. The good news is they do have a lot of cash on hand and access to credit, so they're not in immediate financial danger. They're also expanding their communities, which shows confidence in future demand, but the lower backlog suggests they need to see those new communities translate into sales quickly to boost profits. The increase in debt is something to watch, especially if market conditions worsen. Overall, Meritage Homes is playing a long game with a clear strategy to target first time and first move up buyers with affordable, quick closing homes. The current market conditions are a significant headwind, impacting their profitability. They need to find a way to balance aggressive pricing and incentives with cost control to improve those shrinking profit margins. The company is trying to manage the situation well with lower administrative costs and improved financial services, but the core home building margins are currently under pressure. Alright, that is our breakdown of Meritage Homes' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. It is the best place to continue the conversation. Thanks for watching. See you next time.